When I study markets, I focus on how the system works, not on predictions. Right now, the global silver pricing system is under clear stress. The largest silver exchange holds about 103 million ounces available for delivery, while more than 400 million ounces of contracts exist on top of it. Nearly 800,000 ounces are leaving the vaults each day. In less than a month, the system reaches a decision point on February 27th when participants must choose cash or metal. Systems reveal their truth at moments of forced choice. The question is simple. What happens when too many people ask a paper system to deliver something real? To understand what is happening in the silver market, you must first understand the machine that sets the price. COMEX is not a warehouse designed to distribute metal to the world. It is a financial system designed to trade contracts. Most participants in this system never intend to touch physical silver. They trade promises and they settle those promises in cash. This distinction matters because systems behave very differently when they are built on claims rather than assets. Inside this machine, there are two categories of silver that are often confused. Registered silver is metal that is approved and available for delivery. Eligible silver is metal that sits inside the vaults but belongs to someone else and cannot be delivered unless the owner chooses to release it. When people look at total inventory, they often combine these two numbers. From a systems perspective, that is misleading. Only registered silver represents the system's true capacity to meet delivery demands. Everything else is potential energy, not usable energy. This machine works smoothly as long as most participants agree to close their positions financially. As long as confidence remains high, the system does not need much physical backing. This is how leverage functions inside financial markets. A small amount of real metal supports a large amount of paper claims. This structure is not inherently flawed. It has worked for decades because behavior has been consistent. Most contracts are rolled forward or settled in cash. The problem arises when behavior changes. When more participants decide that they want the asset instead of the promise, the system experiences stress. The machine was not built to handle widespread physical demand. It was built to clear trades efficiently. Today, the amount of registered silver has fallen to levels that make this leverage visible. Roughly 100 million ounces support several multiples of that amount in paper claims. At the same time, silver is leaving the vaults each day. That means the buffer is shrinking while the obligations remain. In systems thinking, this is the definition of rising fragility. A smaller shock can now produce a larger effect. This is not an opinion. It is a mechanical property of leveraged systems. History shows that markets built on trust function until that trust is questioned. When confidence is high, leverage looks stable. When confidence declines, leverage becomes a liability. The silver pricing system is entering a phase where small shifts in preference can create outsized consequences. This does not mean the system will fail. It means the range of possible outcomes has widened. Intelligent decision-making begins by acknowledging that reality rather than denying it. The most important question at this stage is not what the price will do, but whether the structure of the machine can absorb the behavior it is now encouraging. In every economic system, inventories exist to absorb shocks. They are buffers that allow demand and supply to fluctuate without breaking the machine. When inventories decline, the system becomes more sensitive. Small changes in behavior begin to create large outcomes. This is a rule that applies across history and across markets. The silver market today is a clear example of this principle at work. Registered silver inventories have declined by roughly 70% since 2020. That means the buffer protecting the system has been steadily removed while the structure of paper claims has remained largely unchanged. This creates a widening gap between what is promised and what is available. What matters most is not the absolute level of inventory, but the rate of change. In January of 2026, nearly 50 million ounces of silver left the COMEX vaults. 2 years earlier, the annual outflow was less than 7 million ounces. This is not a linear change. It is an acceleration. In systems thinking, acceleration signals a transition phase. It tells you the system is moving from stability toward instability. When metal leaves the vaults each day, the system loses optionality. It has fewer ways to respond if demand increases. At the same time, the daily outflow of roughly 785,000 ounces shows that this pressure is continuous, not episodic. This phenomenon is not isolated. Inventories in Shanghai are at their lowest levels since 2016. The London Metal Exchange also reports historically low stockpiles. When independent systems across different regions display the same stress pattern, it suggests a global cause rather than a local anomaly. From a cause-effect perspective, this means industrial demand and strategic accumulation are drawing metal out of circulation faster than it can be replaced. That process does not reverse quickly because supply responds slowly. Mines cannot scale production on short notice. Refining capacity cannot expand overnight. This creates a lag that reinforces the pressure already present in the system. As inventories fall, the leverage embedded in paper markets becomes more dangerous. Leverage is efficient when confidence is high and buffers are thick. It becomes unstable when buffers are thin. This is how financial systems amplify small behavioral changes into large price movements. The silver pricing system has reached a stage where the margin for error is narrow. A relatively modest increase in physical demand could overwhelm the remaining inventory. This does not require panic. It requires only rational actors responding to incentives. The most important insight here is that declining inventory changes behavior before it changes price. Participants begin to think differently about risk. They start to question whether promises will be honored in form rather than in cash. This shift in mindset is often invisible until it reaches a tipping point. At that point, outcomes appear sudden, even though the causes have been building for years. Understanding this process allows you to anticipate stress rather than react to it. Systems rarely surprise those who study their structure honestly. When I want to understand whether a system is under real stress, I do not look at headlines and I do not start with price. Price is often the last variable to adjust. I look at costs because costs reveal scarcity before it becomes visible. In the silver market, the most important cost is the silver lease rate. The lease rate is the interest paid to borrow physical silver. It reflects how easy or difficult it is to obtain real metal inside the system. In normal conditions, this rate is very low because silver is assumed to be plentiful. Historically, it sits well below 0.5%. At those levels, borrowing silver is routine and the system functions smoothly. Today, that cost has risen to roughly 8%. From a systems perspective, this is not a small change. It is an order of magnitude shift. When the cost to borrow an asset increases this dramatically, it tells you that the balance between supply and demand for the physical asset has changed. This is a cause-effect relationship that appears repeatedly across cycles. When money is scarce, interest rates rise. When commodities are scarce, borrowing costs rise. Silver is behaving no differently. The lease rate is the system telling you that physical silver is harder to find than it used to be. This matters because the silver pricing machine relies on the assumption that physical metal can always be sourced when needed. When that assumption weakens, behavior changes. Traders who short silver must borrow metal. If borrowing becomes expensive, fewer participants are willing to maintain those positions. Industrial users who require silver as an input begin to think defensively. They prioritize certainty of supply over price. This shifts demand forward in time. When demand is pulled forward, it creates additional pressure on already declining inventories. This feedback loop is how stress compounds inside a system. It is important to understand that this signal is not speculative. The lease rate is not driven by opinion. It is driven by transactions between counterparties who need metal and those who control it. When someone is willing to pay 8% to borrow silver, it means the alternative is worse. Either they cannot secure supply elsewhere, or the risk of not having silver is greater than the cost of borrowing. That decision reflects real-world constraints, not market narratives. History shows that these signals appear before major transitions. In previous cycles, rising funding costs preceded volatility in price and changes in market structure. They were early warnings that the system was operating closer to its limits. The same pattern is visible here. The silver market is not yet broken, but it is tighter. Tight systems are less forgiving. They respond faster and more violently to changes in behavior. The key question is not whether this signal guarantees a specific outcome. It does not. The question is whether ignoring it increases risk. In my experience, the answer is yes. When costs rise across a system, they are telling you where the pressure is building. Understanding that pressure allows you to think probabilistically rather than emotionally. That is how you prepare for change before it becomes obvious to everyone else. Financial systems do not collapse because of rumors or emotions. They reveal their weaknesses at specific moments when participants are forced to make real choices. In the silver market, that moment is the first notice day for the March contracts, which occurs on February 27th. On this day, holders of futures contracts must decide whether they want to settle for cash or take delivery of physical silver. This decision is not symbolic, it is mechanical. It determines how much stress the system must absorb in a very short period of time. March is one of the largest delivery months for silver. Historically, this is when the gap between paper claims and physical availability becomes most visible. The current structure shows roughly 500 million ounces of open contracts against a much smaller pool of registered silver that can actually be delivered. In normal cycles, this imbalance does not matter because most participants choose cash settlement. The system relies on that behavior to function. The risk emerges when behavior changes even slightly. If only a small percentage of contract holders request delivery, the amount of metal required rises quickly relative to what is available. To understand this, you must think in nonlinear terms. If 10% of contracts stand for delivery, the system must source tens of millions of ounces in a short window. If that number rises to 20%, the required metal approaches the total registered inventory. At that point, the buffer disappears. The system loses flexibility. Every additional request creates exponentially more pressure because there is no margin left. This is how leverage transforms from an efficiency tool into a source of instability. Recent data shows that delivery rates have already increased sharply. In February, a very high percentage of eligible contracts resulted in actual delivery. This indicates that participants are acting differently than they have in prior cycles. When rational actors change behavior, it is usually because incentives have changed. Physical silver is harder to source outside the exchange. Delivery delays from dealers have lengthened. Premiums in other regions have risen. In this environment, requesting delivery becomes a logical choice rather than an ideological one. From a systems perspective, February 27th is not a prediction date. It is a diagnostic date. It forces the system to reveal how elastic it truly is. Either enough participants accept cash and the system absorbs the pressure, or enough participants demand metal and the structure is tested. The outcome does not need to be extreme to matter. Even partial stress can alter pricing dynamics, market rules, or settlement behavior. History shows that decision points often precede rapid adjustments. These adjustments are rarely orderly. They are responses to imbalances that have been building quietly. When observers say events happen suddenly, they are usually ignoring the long sequence of causes that made those events inevitable. The silver market is now approaching such a point. The variables are visible. The incentives are clear. What remains uncertain is how participants will collectively choose. That choice will determine whether the system continues smoothly or is forced to adapt under pressure. When a financial system reaches its limits, it does not simply stop functioning. It adapts. The way it adapts follows patterns that repeat across history. In every major cycle, when markets threaten to break under their own leverage, the rule makers step in to preserve stability. This is not a moral judgment. It is a mechanical response. The silver market is no different. If physical demand begins to overwhelm available inventory, the exchange has several levers it can pull to reduce stress. The first lever is settlement. A system built on contracts always retains the option to settle in cash rather than deliver the underlying asset. From a legal perspective, this is permitted. From a systems perspective, it shifts pressure away from inventory and onto confidence. When participants accept cash instead of metal, the system survives, but its role as a price discovery mechanism weakens. The price becomes less connected to the physical reality it claims to represent. This has happened before in various forms across commodity markets. The second lever is rule adjustment. Exchanges can raise margin requirements, increase capital costs, or impose position limits. These actions force leveraged participants to reduce exposure. History shows that these changes often occur rapidly and in clusters. In 1980, silver prices surged and trading was restricted to liquidation only. In 2011, margin requirements were raised multiple times in a short period, causing forced selling. In both cases, the goal was not fairness but stability. The system prioritized its own survival. The third lever is structural separation. When physical scarcity becomes extreme, paper prices and physical prices can diverge. This is already observable in regional premiums. When a market reaches this stage, arbitrage becomes difficult because the constraints are physical, not financial. Transportation delays, regulatory barriers, and strategic controls limit the flow of metal. As a result, the idea of a single global price becomes less accurate. The system fragments under pressure. What makes the current cycle distinct is the starting point. In previous episodes, inventories were ample. The system had room to maneuver. Today, registered silver inventories are already low. That reduces the effectiveness of traditional interventions. You can change rules, but you cannot create metal. This does not mean the system will fail. It means the range of outcomes has widened and the cost of maintaining stability has increased. From a probabilistic perspective, this environment favors caution over certainty. Systems under stress tend to surprise those who assume continuity. They reward those who understand incentives and constraints. The key insight is that exchanges act to protect the system, not individual participants. If stress intensifies, decisions will be made quickly and without regard for short-term price fairness. Understanding this allows you to remove emotion from the analysis. The question is not whether intervention is good or bad. The question is how likely it is given the current configuration of the machine. History suggests that when leverage is high and buffers are thin, intervention becomes more probable. Recognizing that pattern is essential to navigating what comes next with clarity rather than reaction. To understand whether the current stress in the silver market is temporary or structural, you must step back and look at the longer cycle. Short-term imbalances can be resolved by time and price. Structural imbalances persist because they are rooted in the way the system is built. Silver today is facing a structural problem. For several consecutive years, global demand has exceeded global supply by a wide margin. Estimates place the annual deficit at roughly 200 million ounces. When deficits persist, they accumulate. Over multiple years, this creates a large gap between what the world consumes and what it produces. The demand side of the system is changing in ways that are difficult to reverse. Silver is no longer only a monetary metal. It has become a critical industrial input. Solar panels require silver for conductivity. Electric vehicles use significantly more silver than internal combustion vehicles. Data centers, semiconductors, and artificial intelligence infrastructure all depend on silver. These uses are tied to long-term policy decisions, energy transitions, and technological investment cycles. Once these systems are built, demand does not disappear quickly. It becomes embedded in the structure of the economy. On the supply side, silver behaves very differently. Roughly 80% of global silver production is a byproduct of mining other metals such as copper, lead, and zinc. This means silver supply does not respond directly to silver prices. Even if prices rise, it takes years to bring new mines online, and those decisions depend more on the economics of base metals than on silver itself. This creates rigidity. In systems thinking, rigid supply combined with flexible and growing demand produces sustained pressure. This imbalance explains why inventories have been falling across multiple regions simultaneously. It also explains why lease rates have risen and why delivery behavior is changing. These are not isolated phenomena. They are connected expressions of the same underlying cause-effect relationship. The system is drawing down its buffers to satisfy current needs. When buffers are depleted, the system becomes more fragile. It is important to understand that price suppression or rule changes do not resolve structural shortages. They only redistribute stress. When prices are held down, consumption increases and investment in supply is discouraged. This deepens the imbalance over time. History shows that prolonged deficits eventually force repricing or rationing. Sometimes this occurs through higher prices. Sometimes it occurs through restricted access. Often it occurs through a combination of both. From an evolutionary perspective, this is how markets adapt. Pain signals that the system is misaligned. Reflection allows participants to adjust behavior. Progress occurs when the system restructures around new constraints. The silver market is currently in the pain phase. The signals are becoming louder. Whether the adjustment happens smoothly or abruptly depends on how participants and institutions respond. Understanding this longer-term context is essential. It prevents overreaction to short-term volatility while highlighting why the underlying pressure is unlikely to disappear on its own. Systems driven by structural deficits do not resolve quietly. They evolve through tension. Recognizing that dynamic allows you to approach the next phase with realism rather than surprise. When I reach the end of any analysis, I return to the same discipline. I do not ask what I hope will happen. I ask what is most likely given the structure of the system. In the silver market, the structure tells us several things. Inventories that can actually be delivered are low. Structural demand continues to grow. Supply responds slowly. Funding costs signal scarcity. And the system relies on confidence to function smoothly. None of these variables guarantee a single outcome. Together, they widen the range of outcomes. That is what matters. Positioning in this environment is not about being bold. It is about being resilient. In leveraged systems, the greatest risk comes from assuming stability when buffers are thin. The most important decision is not what instrument to use, but how much exposure to carry. Position sizing is the primary risk control. If volatility increases, you want to remain solvent and emotionally stable. That requires accepting uncertainty rather than fighting it. It is also important to distinguish between ownership and claims. Paper instruments offer liquidity and convenience, but they introduce counterparty risk. Physical ownership reduces counterparty risk, but introduces storage and liquidity considerations. Neither is inherently superior. Each carries trade-offs. Intelligent positioning balances these trade-offs according to your time horizon and tolerance for pain. If you cannot tolerate drawdowns, you are holding too much risk. This is a simple but often ignored rule. The framework is straightforward. Monitor the variables that matter rather than reacting to headlines. Track deliverable inventory, not total inventory. Observe how many contracts stand for delivery during key months. Watch funding costs as an early signal of stress. Ask yourself continually how you know you might be wrong. Seek thoughtful disagreement rather than confirmation. Weight opinions by credibility and evidence, not conviction. Markets evolve through cycles. The transition points are uncomfortable because they expose assumptions that no longer hold. That discomfort is the price of learning. Pain followed by reflection leads to progress. This applies to individuals and to systems. Those who understand this adapt earlier and with less damage. As you move into the day, remember that clarity comes from seeing reality as it is, not as you wish it to be. Stay curious, stay disciplined, and stay humble in the face of complex systems. I wish you a calm and productive day ahead. Thank you for spending your time here. I look forward to seeing you again in the next video.